Asset retirement, point at which the asset is no longer useful and is disposed of. Asset cost and the accumulated depreciation for the asset are removed from the books during this process. There is either a gain or loss typically upon disposition, the act of getting rid of the asset, whether it is sold or scrapped, which may highly likely be classified as extraordinary income, or if in a different business type, it might be in regular income or its own particular line item, depending on the generally accepted accounting principles that follow. So, let's explore this concept a little bit further because there's several layers of learning here. In any given fixed asset, we'll talk about a truck because trucks are cool. Let's say we have a nice business truck vehicle. $20,000. Now every year, this truck has declined in value in one way or the other in the real world, and in the accounting world, there's been a methodology to depreciate the truck over time, meaning write this off, take the expense year by year. So we'll go ahead and put this truck as a 5-year asset. And when we placed it into service, we thought, hey, we're going to scrap this thing at the end. It's not worth anything. So we're going to say every year, 20 divided by 5 was $4,000 expense. So 5-year asset. So in year 1, 4,000 increased accumulated depreciation and also appeared on the income statement as an expense, 4,000. And so after the first year, the net book value or the asset value is going to be 20,000 minus the 4, which when combined, in this case, would equal 16,000. Year 1. But it's probably presented on the balance sheet with the cost here and the accumulation here. Next year, year 2, there's going to be another expense of 4,000. Year 2, 4,000. Now, the net asset value as of year 2 would be 12,000. So here we have this truck, and let's say it died. Truck no more. At year 2, the net asset value is $12,000. If the company is to sell it for $12,000, there would be no gain or loss. But we're saying that this truck was terrible. The truck died. It had to be scrapped, retired for no money in this case. So we have this $12,000 of value that's on the balance sheet, which is essentially the amount paid, the initial book value, minus the accumulated depreciation in year 1 and 2, which was expensed on the income statement. So now this is our net book value. If this was all loss, we would have to eliminate this 12,000 one way or the other, and on the profit and loss, that would equal either extraordinary loss or some other kind of loss for $12,000 because the asset has not been fully written off, only being 2 years in at $12,000. Let's take another random asset. Let's say this is $10,000, and after a certain amount of years, it's written off $9,000. So this was a cost, and this is the accumulated depreciation. So what's really left is 1,000. Now, let's say this is scrapped. Or actually, let's not scrap it. Let's sell it for $2,000. So now, if it's sold for $2,000, then the difference between these two, 2,000 in, book value of 1,000, would be $1,000 gain. Yay! Asset retirement that had a book value or basis of 1,000, 2,000. Now, just for the sake of making things very complicated, how would this work in T accounts? Much more complicated. You'd have the asset starting at 10,000. You'd have the accumulated depreciation at 9,000. So these are just the specific T accounts to this particular scenario. Net asset value being 1,000. So now what the heck happened? That is the easiest way to start, is the cash. So we sold for $2,000. Cash came in. Step 1. So you know cash came in. And whenever you do a transaction that involves asset and accumulated depreciation, you have to reverse these out. So you need to equal these out with a 10 and then a 9,000 over here. So we close these out. And in order for this entire transaction to balance somehow or another, we are going to need to show the $1,000 gain. So gain is going to be $1,000, which is essentially due to the fact that accumulated depreciation had to come out, and there was a gain on the difference between the basis as well as what was actually received. So we get rid of the asset, we get rid of the accumulated depreciation, we bring in the cash, and then there also has to be a gain of some sort, in this case, in order to balance out the entire transaction. That is just a very brief overview without getting highly technical with the debits and credits and sale asset dispositions. But this is an introduction to asset retirement, because assets do not last forever. Sometimes they just go away, sometimes they're scrapped, and they're usually a gain or a loss at the end of the transaction, which also has a way of being expressed with debits and credits. This has been accountingplay.com. Thank you.